Don't forget to subscribe, like, and hit the notification bell. Hey everybody, it's Kevin Wadsworth from NorthStarBadCharts.com, and I'm here to talk to you today about some stuff that's going on in the markets at the moment that I think is highly significant for what is going to be happening later on this year. And we've got some real important stuff to be aware of, I think, around what's going to be happening in the markets later on this year, and could be quite dramatic, I think. Now, you're probably used to seeing podcasts and videos of people talking about dramatic stuff that is going to happen next week, next month, next year, and often it never seems to happen because the markets can remain buoyant for longer than many people think. But my background is in forecasting for aviation, so particularly military aviation, and that involved bringing together, using a lot of computing power, of course, bringing together a lot of pieces of evidence to assess what's going on with the global atmosphere in 3 dimensions. And that is pretty much the most complex sort of dynamic that you can try to predict. In order to forecast the weather a few days ahead, you really need to know what's happening to every molecule of gas in the Earth's atmosphere and know where it's going. If you're going to do it with 100% accuracy. And the computer models are incredibly complex, trying to get a handle on all of that. But the point is that the techniques that the computer models use and the techniques that trained and qualified forecasters are taught are strongly centered around a process of evidence gathering and something called ensemble forecasting, where you bring together all that evidence, then you forward project it. And each time you forward project that evidence, you make some minor tweaks to what is happening at the moment, and you see if that forecast still leads in the same direction, or whether it produces a series of forecasts that are all leading in different directions. Now, effectively, that gives you your confidence levels, because if all of the predictions are pointing in the same direction, your confidence can be high. And if all of your predictions are scattered all over the place, then your confidence levels are low. Now, that's important because there are times in the periods of time when all of those things start to come together and start to point in the same direction. I believe we're at that point now, and we're getting some clear signals and some clear signs of the way things are likely to pan out in general terms. So that's what I want to talk to you about today. We're going to be looking at gold, we're going to be looking at bond yields, we're going to be looking at stock markets. And towards the end of the video, I'm going to spend maybe 5-10 minutes just talking about risk and money management, because if you're new to the world of trading and investing, that is critically important, particularly with keeping in mind what I'm about to say about what's likely to be coming for the markets and what we're likely to be facing over the next, let's say, 12 months or so, 6 to 12 months. Okay, I'm going to stop with all the babbling there, and we're going to start looking at the technical evidence and the charts. So here we go. I'm going to share my screen, and we're going to start off with gold, actually. So that's the screen sharing switched on now. And I think I'll turn my video camera off because you don't need to be distracted with me. So this is the gold chart. And if you've been following me for any length of time, you'll recall that back in 2019, I was able to point out this high confidence entry point. And this was one of those points in time where confidence levels are high. Price had done a certain number of things on this chart that gave us a high degree of confidence. And I don't want to go into the technical ins and outs of what that involves, because we'll be here for a long period of time. But suffice to say that the forecast when we were at 1350, 1400 was for a move to $2,000 followed by a long consolidation. And of course, that's exactly what we've seen. Now, all eyes are on the breakout line for that consolidation, because after 4 years of or 3.5 years of consolidating, when it breaks out, it's likely to lead to the next major move. If it breaks to the downside, it'd be a major move to the downside. If it moves to the upside, then the opposite, of course. Now, gold being gold, it measures purchasing power destruction. So the probabilities are always in favor of an eventual upside breakout, no matter what the correction looks like. And we saw a big correction here between 2011 and 2016. But the probabilities are very, very strongly in favor of gold moving to the upside. It's just like, the price of your house or the price of a loaf of bread. It may dip briefly for a while if your local store has a sale on, but eventually the forces of the market are going to take over, and that house or that loaf of bread is eventually going to get more expensive, measured in US dollar terms, and that's exactly the same with gold. Now we're just broken out and back tested this incredibly important resistance line that goes all the way back to 2011, the peak at 2011. So gold is giving us a signal. That's the takeaway from this chart. It's signaling that something is occurring here, certainly in terms of the precious metals market. Now, moving on to the next chart, and we're going to look at the money supply versus gold. And when this chart breaks to the downside, it effectively signals a bull market for precious metals. When it peaks, you get the bottom of the bear market, and then it breaks to the downside and you get a huge bull market. It's because gold is outperforming money supply. So if this chart's going up, money supply is ahead of gold. And when the chart moves down, gold is ahead of money supply. Now, my expertise is in forecasting and technical analysis. It's not in economics. So I'm not going to sit here and try and explain in terms of economics why this would be the case. It's just an observation. This is a simple observation coming from somebody who has a background and an expertise in interpretation of technical charts. So just sort of take that at face value if you can. And if you have different viewpoints and you feel strongly that what I'm saying here is a load of garbage, then that's absolutely fine. I'm just doing my best to try and convey to you what I think the charts are telling us. And if you've got a different view, then that's fine. There's no need to be cruel or nasty about it in the comments. Just put across your different point of view, and that's absolutely fine. But there's no need to take it personally. But this chart is telling me, based on past evidence, that a large gold bull market is developing, and actually the evidence for that began to emerge some time ago. And so I think we're likely to be in a gold bull market era, as evidenced by this particular chart. Okay, so let's take a look at gold versus the S&P, because gold versus the stock market is critically important in tracking capital flows. There are periods in time when you need to buy gold, and there are periods in time when you need to sell gold. And the periods in time when you want to buy gold is when it starts to outperform the stock market. Because, for example, here between 1969 and 1980, for 11 years, gold drastically outperformed the stock market. And then from 1980 all the way down here to 1999, 2000, the stock market drastically outperformed gold. And then from 2000 to 2011, gold rapidly outperformed the stock market. And then from 2011 to very recently, the stock market has been outperforming gold. Now, if we zoom in and look at what's going on here, we can see, and I'll put it on the monthly view here instead of the quarterly view, what you can see is that we appear to be forming a bottoming pattern here. And as in previous examples, it's in the form of a support line, which is a perfect geometric arc. And this ratio just hit the edge of the arc and is breaking out. And if I look at it on a weekly analysis with weekly candles, you can see that we've formed a wedge and broken out, which is highly significant. It doesn't necessarily tell us that gold is going to go on a massive long bull market versus the S&P, but it's telling us that at least that it has broken out from the recent downtrend. And when viewed on the quarterly chart, each one of these candles covers 3 months now, then we can see that we're just maybe at the start of a developing uptrend. Now, whilst we're in this red segment here, nothing too dramatic is going on. Gold could get to the top of this red segment, and by the time it gets to the top of the red segment, it could be $3,000. But that 0.5 level, where gold is worth 50% of the stock market, so for example, if the stock market is 6,000 SPX and gold is 3,000, so that could be the case in a few months' time. We could have gold at $3,000 and the S&P at $6,000, or some variation of that to give us 0.5. But breaking above this critical 0.5 resistance line brings us strong and increasing evidence that gold is then in a period of likely extended outperformance versus the stock market. There's a whole series of evidence here. We've got the 7-year moving average, and when the ratio breaks above the 7-year moving average, it's an indicator that that gold is in a period of outperformance versus the stock market. And the 7-year moving average at the moment is 0.47, which is quite close to that 0.5 level. So that's another piece of evidence close to 0.5 that points us in the direction of a gold bull market. Now, all these are just pieces of evidence, but when you start adding them together, they build a picture, just as those computer models build a picture for us in the world of meteorology and forecasting for, in my case, forecasting for aviation. And it's the same process. It's an evidence building process. This is the quarterly gold chart going back to 1969 or earlier, in fact. And what it's identifying is the cyclical behavior of the gold market. And we know that the markets have cycles. The stock market has cycles. And if you're a cryptocurrency fan, you'll know that Bitcoin has cycles. Bitcoin has a 4-year cycle, just the same as gold does. And that 4-year cycle in gold spreads out to an 8-year cycle. Now, people call it an 8-year cycle, but actually, in reality, it's between 7 years and 8.5 years. Go all the way back to 1969. The shortest cycle was 28 quarters, which is 7 years. The longest cycle was 34 quarters, which is 8.5 years. And the cycle is measured from low point to low point, not from high to high, but from low to low. Those lows mark the cycle bottoms, and that's what we measure the cycle length by, from low to low. Now, if we look at the recent price action for gold, many people thought or assume that the 7 to 8.5 year cycle for gold was, well, in fact, some people are suggesting it was late last year, I think, in October of 2023. But when you look at this quarterly chart, it's really barely registers on there. If you're going to call a major cyclical low, it'd be this one here in the quarter beginning July 2022. But that's, in my view, too early. I would expect a longer period of time than that. 27 quarters is short. It's possible, but it's short. And if you consider that the cycle lows have been in the year 2000, the year 2008, late 2015, early 2016, then you would think 2024 is a year to consider seriously for an 8-year cycle low. Okay, so that being the case, if we were to, as I suspect, have an issue later on this year, and I'll show you the evidence for that, then it would be likely to take down precious metals as well, just as it has done in the past. 2008, for example, where gold fell 30%. So if we have a market event later this year, and I'll move on to the evidence for that shortly, then gold is likely to be brought down with it, again, probably by 25 to 30% would be my estimation. Now, if it does that in the quarter beginning October, so Q4 of this year, that gives us a 36 quarter cycle, which would make it the longest low to low cycle in the past 50 years or more. So that seems a little bit counterintuitive, but when you consider that the previous cycle was only 28 quarters, you then have a 16-year cycle of 64 quarters. 28 plus 36 is 64 quarters. And that compares favorably with previous 16-year cycles, 63 quarters here and 66 quarters here. So having this short 8-year cycle, or it turned out to be 7 years, it would make some sense if the next cycle were to balance that out, and we have an extended low to low cycle, giving us a low point towards the end of this year. So my gut feeling from these charts is that gold is going to, well, is breaking out now. And if we get a quarterly confirmation at the end of the March of this breakout, then my expectation is for a significant upside move, followed by a very significant downside move, followed by an emerging, very large precious metals bull market. And again, I'll go on to explain why in a second. So the next chart is the 10-year yield chart. So here is that 10-year yield chart, and let's go through it in a little bit of detail just so that we can see what it's telling us and why it's giving cause for concern. So this is the yield on the US government 10-year dated debt, 10-year bond, and the interest that is paid on that, or the yield. And we can see three, in fact, four distinct paradigms, if you want to call them that, or four distinct eras. One was over here before we broke out back in the 1950s. The next one was from, let's say, around about 1956 through until 1980. The third one was from 1980 through until 2022. And we're now in the fourth era for bond yields, as shown on this chart anyway. Okay, you notice a couple of things here straight away. I've labeled these the pain line. And it's the pain line because when you cross, or when the yield crosses that line, we have a problem, we have difficulties, and particularly in the situation that we're in at the moment. So in the 1950s, the 10-year yield broke out above the pain line and started to climb. Now, the 10-year yield was climbing in an environment of high inflation or rising inflation. Prices, as measured in US dollars, were increasing steadily in what most people understand as inflation, everything around them inflating to higher levels. It was, in fact, of course, the US dollar losing purchasing power at a rapid rate. Now, that continued until 1980. And at the same time, fortunately, debt to GDP was dropping. So the rate at which debt was accumulating was being outstripped by growing GDP. That made it somewhat easier, I suspect, for the Federal Reserve to raise its Fed funds rate or interest rates from 1.4 to 16 point, roughly 16.4%. And that was sufficient to bring about the dynamics to control inflation. And there are other things going on as well that contributed to this. But the main point is that debt to GDP was falling and inflation began to be contained, and complete and utter disaster was avoided. Any kind of scenario was runaway inflation and hyperinflation was avoided. And we entered a 40-year, more than 40-year era of declining bond rates and interest rates, sorry, not bond rates, bond yields and interest rates. And we became accustomed to that after a couple of decades had passed, and repeatedly interest rates were cut. Every time they began to rise, they were cut again. Every time they began to rise, they were cut again, until eventually we were pretty much at zero. Now, that was because, I suspect, because at the same time, debt to GDP was rising from 31% to roughly 130%. So debt was rising at an astonishing rate and completely outstripping any rise in GDP. I don't know why it says GDP. It should say GDP, gross domestic product. There we go. So that was the era until 2022. And then something happened. In fact, during the COVID pandemic panic, along with a lot of other markets, everything kind of tanked and fell through the floor. And that marked it was a sort of a shockwave that rippled through the entire financial system, and it ended the previous era. Now, call it coincidence, call it what you like, but the COVID pandemic was the turning point, because at that point I was able to say, well, this is a false breakdown. It's an expanding descending wedge, which is typically very bullish. So it breaks to the upside. And in this particular case, the fact that it had broken down and was down near zero left only one direction for this thing to go. And it was likely to be like a rubber band snapping in the opposite direction. And the energy was sufficient to carry it straight through the pain line and into this new regime that we're in now. And it's a new regime because there's a reason why that pain line was there, why that resistance line was there. And it was there because bond yields above that level were unsustainable. Why were they unsustainable? Well, because the amount you're paying to service the debt has to be contained. But if the debt rises at too high a rate and you are in an environment of rising inflation, then you've got a problem, because your bond yields are rising, interest rates are rising, and your debt is increasing, which makes your debt more unsustainable unless somehow you're magically able to increase GD capital P. So uh, that's the only way to solve this equation, really. There are a couple of ways to solve it, I suppose. One is to stop printing money out of thin air and stop increasing your debt mounting. That's one way. And another way is to get to a position where GDP is able to outstrip your rising debt. And then that will help to solve the issue. But as long as we're above this pain line in an environment of rising debt, rising yields, then we've got an issue, and it's a problem. And during the 1960s and 70s, that led to a developing situation, like a bit like frogs in a boiling pan. You don't really realize what's going on through the 1960s, and then you burst into the 1970s, and particularly the mid 1970s, and things start to really get out of hand. So I suspect that we're in that kind of an era where people aren't really going to realize for a while what's going on until it's kind of too late. Now, moving on from that to stock markets and the SPX. Now, the SPX has been in a relentless uptrend. It had a bit of a tumble back in 2022 and fell from sort of just below 5,000 to somewhere near 3,500. So quite a big pullback there, but it's since recovered and broken to new highs. But in the process of doing that, it was carving out a bearish rising wedge. And you can see the stock RSI indicator is now right up at the top here. So we are likely to have further upside energy because the stock RSI is so high. And when it remains high, it's an indicator that we're sort of powering ever upwards until this thing starts to turn down. And the fact that we've broken out from a bearish rising wedge is suggestive from a technical charting perspective that this is going to be unsustainable, and that although we're likely to see a continued rapid upside move, that's very probable, or certainly very possible, the resulting move down is likely to be even more troublesome. You only need to go back to 2000 and the period from 2000 to 2013, where stock markets rolled over, gold broke out, and even in an environment of fairly contained inflation, gold went up 650%. The stock market went nowhere. So for 13 years, those who were invested in the stock market made zero money, and unless they were somehow able to buy these dips and sell the tops. But if you're just invested, like many people are throughout that entire 13-year period, your funds were going nowhere. Whereas if you spotted what was happening and rotated into precious metals, you would have made 650%, whilst this went nowhere. And then you'd be able to rotate back into the stock market as gold went effectively nowhere. In fact, it fell substantially into a bearish trend, which turned out to be just a consolidation, or is turning out to be a consolidation in an ongoing bull market, which is not surprising because gold just measures purchasing power destruction. So, as I mentioned before, any pullback consolidation is almost very nearly guaranteed to resolve to the upside. So this is a reason to keep an eye on the stock market with a view to it falling substantially and quite possibly going several years without full recovery. That's kind of the scenario I've got in the back of my mind with the evidence from the yield charts, and particularly the yield curve inversion chart, which is putting us in a position where this is very probable. And in fact, we have a deep retrace that sort of bounces around for the next decade before breaking to sustained new highs. Now, the 10-year yield minus the 2-year yield chart, I've mentioned it already, the yield curve inversion. And the yield curve inversion occurs when the 10-year yield minus the 2-year yield is below this red line. Normally, it's above the red line because the number, the 10-year yield, is bigger than this number, the 2-year yield. So your interest rates on the 10-year yield need to be higher for fairly obvious reasons, because if you're holding longer dated debt, you might reasonably expect that inflation could perhaps be more troublesome at some point in the future. So greater rates are paid on longer dated debt and lower rates. So for example, if you had 5% and 3%, 5 minus 3 is 2. So you would be up at the 2 level on this chart. But that's not the case at the moment. The case at the moment is where the 2-year yield is greater than the 10-year yield. So you end up with a negative number. That's not the normal situation. And when that situation unwinds itself and moves back into situation normal, you might want to call it, that process is associated with a problem, or it always has been in the last certainly 50 years. And you can see the early 90s recession, the Asian crisis, the dot-com bust, great financial crisis, subprime debacle, repo liquidity, and COVID crises, all marked as the chart was interacting with the red line there. So something's coming. I don't know what it is, but an event of some sort is on the horizon, and it may very well be tied in with a plunging stock market, rising gold. In fact, if the stock market plunges, everything's likely to go down initially. But as I've said, I suspect precious metals, gold, and commodities will benefit greatly following that from the weight of evidence and the charts that I've studied. So the point is that something is on its way. So we've got an impact matrix here, and I've stolen this from the world of meteorology here in the UK, where we use impact tables to issue weather warnings. And it's an assessment of the likelihood of the event, and if the event occurs, what the impact will be. Now, if this event occurs, the impact will be high. So we are automatically in the right-hand column of this table. It's the high impact column. So that's where the check mark goes, or the tick in the box goes in the right-hand column. Now we have to assess the likelihood, constantly assess the likelihood of that event happening in the next few weeks or the next, let's say, month or two. Now, currently, the likelihood is relatively low because this chart is going to take a while to move up and interact with that red line there. And even when it interacts with a red line, it can take a while for the crisis to break and for the wheels to fall off. So there's other evidence to consider around other technical charts, stock markets, precious metals, oil, all sorts of energy, all sorts of other technical charts to look at. But as this event becomes much clearer and much more visible to us, then this check mark in the matrix is going to move up. And so instead of being where it is now, it'll go up into the medium likelihood of high impacts. And as it becomes pretty much inevitable, and we're starting to see things breaking down severely, then we'll be in a high likelihood, high impact scenario. But for the time being, although it's a high impact scenario that's coming our way, the likelihood of it happening in the immediate future is relatively low. Keeping an eye on that, of course, for all of our website members, and we'll update as time progresses, and as this little bull flag, which is what it looks like, resolves and probably begins to move to the upside. Now, I said at the start I was going to talk about Cameco. Well, actually, I didn't say I was going to talk about Cameco. I said I was going to talk about risk and money management, but I'm using Cameco to illustrate that. Cameco is a uranium miner, and it's a trade that we played on our website recently, entering at $31.30 when we had a confirmed breakout, a monthly confirmed breakout, and we estimated our target using weight of evidence techniques to be $49.50. That was the measured move. Okay, that was our target. Now, price initially began a little pullback, and then it accelerated, another little pullback, accelerated, pullback. That's all bullish price action until we hit the target. We exited at $49.50, right on that candle there. Okay, so that's great. It doesn't always work out quite as perfectly as that, I'm the first to admit. And this is why risk and money management is so important. And I'm just going to hopefully bring a light bulb moment to some of you who are watching this. The stock moved 58%. You can see 58 marked on there. It moved from 31.3 to 49.5, a 58, 59% move. Great, but that's not the number that matters, because how much money did you put into the stock? How much of your portfolio, how much of your savings did you put into it? If you put all of your money into it, you're A, very foolish, B, very lucky, and C, made 58% gain. That's not the way to do it, and that's not the way to talk about trading. If you're doing it that way, then you're doing it. This isn't financial advice. I'm not a financial advisor, but in my view, my personal view, it's completely wrong. The way to trade as opposed to investing is something different. The way to trade is to use risk and money management, and this tool on TradingView helps you with that. So what do you do? You've got two areas marked here, the red area and the green area. The boundary between the two is your entry point, 31.30. The top of the green area is your exit point, your target, and the bottom of the red area is where you will exit the trade if it goes against you and it all goes wrong. Now we've set that just below the breakout. You see that? I just put the over the line there. It's just below the breakout, and it's also just below this candle here with the wick on it, sort of the breakout candle. If it goes below that, then technically you're going entirely in the wrong direction. Something's not right, and you should be out. Okay, so you double click on that and you tell the tool how much your pot of money is. How much money have you got to invest? And we're assuming $100,000 is your overall investment capital. It could be $10,000, it could be $2,000, it could whatever. You put the number in there. And then you say, how much risk do I want to take? If it all goes wrong, how much am I prepared to lose out of that $100,000? Well, as a general rule of thumb, 2% is a reasonable figure. Different people have different views on what's a reasonable figure about how much you're prepared to lose on a single trade. And some people say 0.5% or 1%, but let's just assume 2%. So if the trade goes against you, you will lose 2% of that 100,000. So you will lose $2,000 if it goes wrong. Okay, $2,000, 2% of your 100,000. Now, if the trade works out, and this is the clever bit, it's telling you what your risk to reward ratio is, 3.29. So you're risking 1 to win 3.29. For every one you risk, you're getting 3.29 back. So if you risk 2, you're getting 6.6 back. Okay, you risk $2,000, you're getting 6,600 back. Now, on the basis of the numbers that I've just given you and the basis of the numbers that we put in, it's telling you to buy 361 shares. So you buy 361 shares at $31.30, and that's going to cost you $11,331. That is 11.3% of your NAV, your net asset value. Remember, I said you're starting off with $100,000. Obviously, if you're starting off with $10,000, then instead of 11,331, it's going to cost you $1,133. Okay, so you can adjust these figures. They're all proportionate in terms of percentage. But if you start off with $100,000, you buy 361 shares at that price, it's going to cost you $11,000. So you're using roughly, well, you're using exactly 11.3% of your overall capital for this trade. Okay, and from that 11.3% that you're using, the most you can lose from your original 100,000, as I've said, is 2% or $2,000. Now, if the trade works out, which in this case it did, you come out with $6,571 profit. So your NAV increases from 100,000 to $106,571. So as you can appreciate, because you're risking 2% each time, you can have another 3 trades like this that completely fail, and you're just back to where you started because you'll have lost 6%. In fact, you'll be slightly above where you started because you've got 106,000 here. So, you know, we're not compounding the gains here. We're assuming you start back at 100,000 each time, but of course you've now got 106,000. So, you know, the numbers are even more in your favor. So I hope that's a bit of a light bulb moment for some of you. Think not in terms of rising 59%. Think in terms of how much has my NAV gone up? What was my risk to reward? How much would I have lost if it went against me? And you know, I'd encourage you to play that this little segment of the podcast over and over several times until you fully understand that. I'm not a financial advisor. This isn't financial advice. It's just a suggestion from me to try and save a lot of people losing a lot of money that they don't want to lose. Okay. Right. Well, that's it from me. That's your summary from me about my macro view of the stock markets, precious metals, overall where we're headed, the sort of era that we're in, and I've finished off there with some risk and money management suggestions for you to think about. So if you strongly disagree with anything that I've said there, like I say, just pop it in the comments. No need to be rude, or no need to take offense. This is just my view, and I'm trying to help you, nothing more than that. So take it as it's intended, which is just some friendly advice and hopefully helpful advice. Enjoy the rest of your day, and no doubt we'll speak again very soon. Bye bye.